Welcome to our podcast series, Talking with Traders, hosted by expert trader Garth McKenzie in London, from where he's interviewing various guests on the topic of trading.
Welcome back to Season 7 of Talking with Traders. We're now into the fourth year of this podcast since it started in early 2020. Once again, IG have come on board as our sponsor for this season. We are truly privileged and grateful to have such a global leader in CFD trading as our sponsor. Over the coming weeks, I'll be interviewing various guests from around the globe on the topic of trading. Some will be follow-ups with past guests, and some will be new guests. The idea behind this podcast is that you get a variety of views from a broad spectrum of market professionals. None of what you hear in these episodes is intended to be financial advice, but it is intended to get you thinking about how you might be able to apply what you hear here into your own trading and investing. Please remember to subscribe to this podcast in your favorite podcast app. That way you'll be notified when new episodes are released. Once again, thank you to IG for funding and sponsoring this podcast into its fourth year. And thank you, listeners, for tuning in. Please enjoy Season 7 of Talking with Traders. Welcome back to another episode of Talking with Traders. And this week it gives me really great pleasure to interview somebody from the USA, somebody who I have seen on TV many times in the past, and no doubt listeners will have as well. His name is Adam Johnson. If you are watching this via the YouTube video, you can see him there. He's got a familiar face. You would have seen him on Bloomberg many times. But Adam, you've got a far more interesting career besides the time that you did at Bloomberg, which you can tell us about. But welcome to Talking with Traders, and thank you so much for joining me today. It's really a privilege to speak to you.
Oh, thanks for having me, Garth. It's a privilege from my point of view, and I really enjoy the opportunity to have a long-form conversation. So let her rip.
Cool. Well, we've got long form as in about 45 minutes, so let's do it. I have given a tiny bit of the background into you, obviously as a Bloomberg anchor, where you got to interview very senior, very proper people, CEOs, leaders in various different fields, etc. You now run your own show, Bullseye Brief, the newsletter, but that's not all you do. There are other things as well, which we'll talk about. But I think can you give us a little bit of a background into your career, including the Bloomberg stint? But there's so many other things that you have done when I looked up your bio. More than just being an anchor at Bloomberg, you've got a lot of experience in the markets.
Oh, well, thank you. I appreciate that. Yeah. It's been a journey as most people's lives, sort of end up being. And I went to Princeton as a pre-med, had a wonderful economics teacher who convinced me or helped me see the fact that I absolutely loved economics. So majored in economics and went right to Wall Street and spent, call it 20 years, trading stocks, options, and commodities, really oil in particular. And in the middle of the financial crisis, I was going on Fox and Bloomberg a fair amount, CNBC to a certain extent. And the people at Bloomberg said, "Would you ever make TV a full-time thing?" And I said, What do you mean? They said, "Well, we've just hired journalists. We've never actually hired someone from the street. You've been managing money for 20 years. Again, this is 2008, 2009. They said, "The world is imploding and we need someone who can speak from experience and expertise. Would you join us?" I went to my boss. He said, "You got to do that. No one gets a look like that." So yes, I spent 5 years at Bloomberg hosting a couple of different shows, including the morning show, which meant that I had no life because I had to get up at 3 a.m. every day to do the show 6 to 9. But after doing that for several years, I missed being in the game, and I wanted to have my own business. So I launched Bullseye Brief, a newsletter, which puts out a new stock idea every week, manages a portfolio. That has grown into the American Ingenuity portfolio because I'm a growth-focused investor. And American Ingenuity, the people, companies, and technologies driving our world forward, that's my focus. The newsletter then, because people started reading me every week and getting comfortable with my process and my stock picks, that birthed a money management business. So so that is now the next component of what I'm doing. So yeah, you're right when you say it's been an evolution. When I look back, it all makes perfect sense. But you know, there were certainly times along the way where it didn't. And so that's the benefit of hindsight. But I do absolutely love what I do. I'm an optimist. I'm a risk taker. And that's my story.
Yeah. Well, when you say you love what you do, I know, because the way you sign off your weekly email most weeks is, I love this business at the end.
Right.
And it's true. The passion is there. It shines through in the work that you do.
Oh, thank you.
The main reason I wanted to interview you today was to talk about that American Ingenuity portfolio and to talk about Bullseye Brief, because that's kind of what where I follow you currently. And I love the idea behind the American Ingenuity portfolio, because I guess it's the name is, you know, does what it says on the tin, American Ingenuity. It's growth, as you said, and it's the themes that are at the forefront of tomorrow and in the next decade, in the next 2 decades, etc. I like that. I think, you know, if you're an investor wanting to try and capture, you know, let's just say you're, you know, an early investor in Google or an early investor in Amazon or Microsoft or Tesla, I mean, you've done phenomenally well. And that's the holy grail, I guess. We, as investors, we would love to get in on the ground floor on some of those types of businesses. And I guess that's what you're doing with the kind of research that you're doing, publishing it in a newsletter, putting it into a portfolio, and some of those stocks that you are invested in, I guess, could become the next Tesla, Microsoft, Google, Amazon, etc. In your video bio on your website, something resonated with me with what you said there, is that a mentor of yours on Wall Street said to you once, if you really want to make it in this business, find a theme and leverage it. And I think, well, that's exactly what you're doing here. So with that in mind, you know, what are the themes that you are picking up on for, let's say, the next 5, 10, 20 years that we should be considering for our investment portfolios if we want to capture that next big leg of growth?
You know, it almost sounds cliche at this point to describe artificial intelligence as a theme. It's just so self-evident. And yet that's an obvious theme and one we can all understand. In fact, it's funny, for my bullseyebrief.com subscribers, I wrote up NVIDIA less than a year ago, believe it or not, Garth, at 175. Sure. And my initial target was 475. And I said, there's actually a bull case, I think, that probably gets us towards 700. So it went to the stock, you know, went to 475 a lot sooner than I expected. I sold half the position because, you know, that's risk management, right? As one of my mentors said, always pick a target price before you buy the stock, because you're only rational once, and it's before you buy the stock. Right? Yeah. So, you know, if it gets there, sell half. I did sell half the NVIDIA position. The reason NVIDIA has become such a proxy for artificial intelligence is because their chips enable artificial intelligence to happen. Their chips are 10 times faster than any other chips in the world, 30 trillion calculations per second.
Wow.
They've got a next generation that's going to be 5-6 times faster than that.
That's incredible.
Yeah, amazing. So, you know, in the same way that back in 2000, every company became a .com company, and then somewhere around 2010, every company became an e-commerce, you know, company, or direct to consumer. And then somewhere around 2015, every company became a cloud-based company, right? Well, artificial intelligence, well, and then data analytics was somewhere in 2018. And now that next evolution is artificial intelligence. I think every company is trying to become an artificial intelligence company, or at least employ artificial intelligence in some capacity. I mean, one of the news items from this week is that Amazon is buying an AI company that's going to help them create chatbots that will talk to you and, quote, personalize the shopping experience. You know, we've only just scratched the surface on all this stuff. So artificial intelligence, an incredibly powerful theme. And yes, how do you make the most amount of money on Wall Street? As my boss would say, find a theme and leverage it. Artificial intelligence is a massive theme. There are other themes out there: digitization, robotics, automation, etc. But certainly, artificial intelligence is one of the biggies.
Right. Okay. All right. And the next question then is, once you've identified the theme from a top-down perspective, you've then obviously got to go in and start doing your stock selection. So we assume artificial intelligence is the theme, or digitization is the theme, or robotics is the theme. But now you've got an array of different companies that you can look at. What are some of the criteria that you then want to see at an individual stock level that would make you want to put it into your portfolio? Because when your portfolio it says it's 35 to 50 stocks, so it's fairly diversified, right?
Yeah.
But there's a lot of stocks out there to pick from. So to try and find the best 35 or the best 40 stocks, it's still quite a task. So you've got to really sieve through the data quite carefully, I guess. And to that extent, then what are the criteria that you're wanting to see in a stock for it to actually make it into your portfolio?
Yeah, three things. Every Bullseye pick shares three attributes. Number one, a great story. Number two, data that supports the thesis. And number three, some sort of identifiable, almost newsy catalyst where we can say, yes, that's where we're going,
Okay.
right? And that third one I wouldn't have appreciated had I not worked at Bloomberg in the news business, for 5 years. So all the experience of the past 25, 30 years, kind of adds up. So great story, compelling data, newsy catalyst. Those are the three things that I look for in every pick. Okay. All right. Something that's just sprung to mind regarding this is, in most growth sectors, growth stocks, there seems to be like I think they call it a sigmoid curve or something like that. It's like an S, right? Sure. You get that initial growth. That's the hype. That's the excitement. The stocks become overvalued at that point in time. The theme is still valid, but there's a time when it's just the prices are ridiculous. That's like the dot-com bubble in 99, 2000. Then you get the sort of the return to reality, which is often quite aggressive on the downside. And then you get the bottom flattening out of that curve where the men are separated from the boys, I guess. And then you get the proper uplift, which is where you get the true winners, the true leaders of the theme will actually then rise out of that. I mean, in some respects, some of the stuff, I get the feeling we've actually been through the first part of that S, and we kind of come down with the market correction last year in 2022. Tech was largely out of favor. Not all. I mean, obviously, it's something like Nvidia still did really well. That was an outlier. But a lot of those stocks which had boomed massively in the lead up to the end of 2021 saw big declines in their share prices. 2022 have flattened out quite a bit now over the last, say, 9 months or so. And I see a number of them starting to almost lift off again. Let's hope so.
Yeah. I mean, I guess selfishly, and not only selfishly for listeners to this podcast, I mean, to me, that would now seem like a really good time to be fishing for the top companies, for the best ideas, because you've actually been through that initial bubble. You've seen the burst, and now the stocks that start to lead out of this basing formation that we're seeing now should theoretically be the leaders that ultimately make it in the long run, right?
Oh, absolutely. And the reason, by the way, that stocks are down is because interest rates are up. Yeah. I know that sounds simplistic, but that's the truth. And there are a couple of reasons for that relationship. Number one, companies' borrowing costs go up. So if you're a young, growthy company and you've got to borrow money to, because maybe you still don't have earnings yet, that's more expensive, creates headwinds, reduces profitability. Fine, we can all understand that. But there's something more subtle that more sophisticated investors have to wrestle with, and that's called a discount rate. And so just as when interest rates go up, you can't afford as big a house. When interest rates go up, the future earnings are worth less because you have to discount them back to the present at a higher interest rate. And so that's why multiples tend to compress. So if you were willing to pay, let's say 10 or 11 times cash flow 2 or 3 years ago when interest rates were practically zero. Now, for that same company, you might only be willing to pay 5 or 6 times. Right? That's called multiple compression, and it's a function of higher rates, or specifically a higher discount rate. Again, you're discounting future earnings back to the present, adding all those up, and then saying, here's what I think it's worth. That's the math behind it.
Yeah, absolutely. And obviously there's a big leverage component in that. And that's why we've seen some of these companies falling in price by 60, 70, 80% in some cases. That's right. Because that margin compression, when you expand that out to a valuation that was ridiculous in the first place, it needs to correct a long way.
Correct. The other thing that's important, I think, for all of our listeners to understand is something that you touched on. And I'm going to rephrase it as, it's always darkest before the dawn.
Yeah.
And by that, I mean, the Fed is effectively done. Yeah. They have sidelined themselves. They didn't raise rates, at the meeting in September. And stay tuned. We'll see what they do later in the year. But they've kind of said that they might be done. And yet, interest rates have continued to push and push and push. And there's some sort of turn that's, I think, starting to take shape. You can only force rates higher in the markets so far if the Fed itself isn't raising rates, right?
Yes.
I think that's very important to understand. Darkest before the dawn. If you look at what has happened in stocks from call it the highs of July into August, where things turned, and then September started to get uglier. What you've seen is a massive number of stocks get deeply oversold. And again, when you take, by some measures, 80, 85% of the stocks to points where they are now trading below what traders would call the 50-day moving average, that's a washout. And that is actually what happened at the end of September. And so again, darkest before the dawn. We've only seen 6 times in 5 years where stocks have gotten that oversold, and in each case they bounced. So you start adding up all these data points. The Fed out of the market, interest rates probing almost 20-year highs, stocks getting deeply oversold. You start to make a case for some sort of turn. What I've learned in my career is that when I'm uncomfortable, as I have been, because all these things are weighing on stocks, and so many of my stocks have gone down, since the July highs. Yeah, when I'm uncomfortable, that's when I do my best buying, because we're not trying to make money for the next week, the next month, even the next quarter. We're trying to make money for the next 2, 3, 4 years. We want to pick stocks that have a long runway for growth. We're trying to make triples and quadruples and quintuples of our money, right? We're not just we're not buying Bank America at book value in hopes that it goes to 1.3 times book value, from 28 to 35. Sure, that's a fine trade for some people, but that's not what we're trying to do in the Bullseye American Ingenuity Fund. We want to find the growth companies that are leading the world forward.
Okay, brilliant. Now, I know we've talked about stock specifics and the themes and what have you, but there are a lot of thematic ETFs available now. I mean, you want an AI themed ETF. There's a number of those available. You want an energy themed ETF. There's plenty. You want a fintech ETF. You want a robotics ETF. You want a semiconductors ETF. There are many of these available to play a theme. Is that something you would ever do, or is that sort of the lazy man's way of going about playing a theme? Because I mean, what you're doing, I guess, is no doubt you own some of the stocks that are in those ETFs, but you're looking for the best ones rather than just own the ETF. You actually want to pick out the best stocks in the sector and own those, right?
Yeah, I'm a stock picker. And so my job as a research analyst and as a portfolio manager is to first identify the themes that I think have the longest runway. Again, artificial intelligence, robotics, automation, digitization, et cetera. And then figure out which companies express those themes or leverage those themes to the greatest extent. And then I also have to figure out of those companies that could potentially leverage the themes, which are the strongest ones. And by strength, that might mean that have the best products, that might have the best management teams, the least amount of leverage, the most patent protected technology, right? I mean, there are a lot of things that go into trying to find the right name. And then again, as a portfolio manager, actually managing that basket of names in the context of a portfolio. So yes, I could go out and I could buy a clean energy ETF and say, great, there's my clean energy exposure. And yeah, I'll go about and buy the robotics ETF. But the problem is these ETFs, a lot of them have 70, 80 different stocks in them, and they're not all pure plays. In fact, it's very hard. We've been talking about artificial intelligence. It's very hard to find artificial intelligence pure plays. I've mentioned NVIDIA, but the fact is NVIDIA makes semiconductors. I mean, they don't even do artificial intelligence, right? Yeah. That's the picks and shovels aspect, as opposed to the software, right? Picks and shovels, right? You can be a gold miner, or you can sell gold miners picks and shovels. Well, NVIDIA makes the chips that enable artificial intelligence. So it's kind of a backdoor approach, but I think it's a good approach in this particular case. And I enjoy the treasure hunt aspect of trying to find these names that leverage these various.
All right, cool. Well, I mean, now's the time I'm going to press you. We've talked about the themes. We've talked about AI, digitization, automation, robotics, etc. I'm going to try and pull a couple of stock names out of you. I mean, I don't expect you to give too much away, because obviously your work is proprietary, and it's, you sell it for a fee. And also you of course want investors to invest in your portfolio, which we'll talk about, but let's use this as an opportunity to kind of whet their appetite. This is intended to entice some listeners to subscribe to your newsletter, to potentially consider investing in your portfolio. But let's have a look at a couple of stock specifics that would make it into each of those themes that you've talked about now. Some of your favorite stocks.
Sure, I'll give you an example. Since we started with artificial intelligence, let's just kind of stay with that. And this actually ties together a couple of themes: robotics, automation. A company called Symbotic, SYM is the ticker. Symbotic is doing some amazing things. I mean, if you could just see what their automated warehouses look like, I mean, it's like robot ballet. It's incredible. Truck pulls up to the loading dock. Robots go in, pull out the pallets, take the pallets apart, and then scan all the QR codes on the boxes, go stash them away on a shelf. And then when an order comes in, let's say it's a distribution facility that then supports other stores. And so the store says, well, we need 15 TVs, we need 32 pairs of shoes, etc. Robots go out, retrieve all these different things, figure out how to pack the pallets in a balanced way. And then it actually repalletizes all the stuff. And then other robots load it onto another truck. I mean, that's incredible.
That's incredible.
It's incredible. I mean, so you've got artificial intelligence, you've got robotics, and you've got automation all in one stock. Very exciting. They'll do about $1 billion in sales this year, and yet the backlog is $11 billion. And you say, wait a minute, that's 11 years worth of sales? Well, it sounds like they better get bigger. And yes, that's exactly the point.
That's incredible.
So it's an asset-light operation. They don't build the robots. They don't even build the warehouses. They design the robots, they design the warehouses, and they design the software. And then they actually manage them. So they hire other companies to go out and actually create all the stuff. And they had just effectively one production line. Well, now they've got 3. So they're effectively going to be able to triple their output, which means they'll work through that $11 billion backlog. They are currently converting every single one of the distribution warehouses, all 47 of them that Walmart relies on around the country. They're converting them to entirely automated distribution facilities. Again, that's Walmart. And Walmart's the first one to do it. You're going to start seeing other big companies do the same, and it's very exciting. So Symbotic, ticker SYM, is another bullseye pick and one of my favorites. I recommended it initially at like $8. That was less than a year ago. It went as high as 62.
Wow.
and has pulled back into the 30s. I had sold some up at 60 and went back down into the 30s and bought shares back. So I'm very excited about Symbotic.
That sounds an amazing business. Okay. Part of what you said there leads me into the next question, and it's about risk management, because you've mentioned that you have taken profits on some of these stocks once they've, delivered an exceptional performance, which is great. But now, you've got between 35 and 50 stocks in your American Ingenuity portfolio. So it naturally, by virtue of that, I guess, each of the positions is quite small anyway on a total basis. I mean, I guess I presume they're not all equal in size, but I'm sure they're of a relatively similar smallish size, so that the portfolio is quite diversified. But the question is, do you, assuming one of your picks doesn't work out and doesn't do the $8 to $60 thing, and maybe goes 8 and 7, 6, 5, we don't get, none of us get everything right. We're all human. We all are we all potentially make mistakes in our judgment. If that happens in one of your stocks, do you have some sort of a cutoff point or some sort of a stop loss at which point you just say, well, clearly this isn't working. Let's just get out and move on and find something else to occupy that spot in the portfolio?
Yes. I call it an alert. And in my mind, an alert is different from a stop. If it's a stop, that means you stop it out, you sell it, you're gone, end of story. It's unemotional. An alert to me is more of an opportunity to just say, this isn't working. What's going on here? Am I missing something, or is this a function of the market? An alert is an opportunity, therefore, to reflect and maybe to sell, or maybe in some cases to add, maybe a little. You never double down. That's But you might add a little. Say, I'm going to add a little bit. I'm going to add a little bit. And what I have found is that if I set alerts sort of down 30 to 35%, that's usually a good spot to sort of stop, look, listen, think, and either take action or not.
Okay.
If something goes down 50, gets cut in half, at that point, a lot of times I'll just say, boy, this is just not working. I mean, I'm sure there's some listeners who are saying, oh my gosh, you're willing to lose 50, get cut in half, 50% off stock? That's crazy. I don't want that kind of volatility. Yeah, well, welcome to 2023, where a lot of stocks, I mean, think about it. The NASDAQ last year was down, what, 30
odd. Yeah.
39%. And so, are you going to sell everything? No, of course not, because then you're in cash. You have to ride things out. But yes, I have sold some stocks down big time double digits. It's been painful, but once you get those things out of there, you do free up capital. You have to get over it, not berate yourself for being wrong, and then redeploy the capital. In fact, one of the things I had to do last year was stop myself out on some wonderful little growth companies that nobody cared about. And we're getting crushed by rising rates. Again, what we were talking about, where you have to discount future earnings at a greater rate. And that's why these stocks just kept going down and down and down, and people were selling. And I had to move up higher on the quality curve. So, people talk about the FANGs, Facebook, Amazon, Apple, Microsoft, et cetera. And I think those are all core Ingenuity names, and you need to own them. But what I did was I sold some of these great little growth companies, and I went higher up on the quality curve to, well, what I would call the next generation of FANGs. The Palo Alto softwares, the Salesforce.coms. They're not as big as the big guys, but they're pretty darn big, and they're high quality companies with consistent earnings, great products, some stability and protection around their products, and an ability to raise prices, stuff like that you look for. But I had to make that move higher on the quality curve and sell out some of the losers. It was painful, but it certainly worked out. It was the right decision. I'm glad I did it.
Right. Okay. All right. Interesting. Now, on the opposite end of that question is the good news side of it, I guess, is that sometimes you're going to have stocks that perform phenomenally well, like you just said with Symbotic, which went from $8 to 60, and then you took some off the table and it came back, and that sounded like it worked out very well. But I've also seen in the past where trimming back positions can be detrimental to your growth health. Let's put it that way. If you had have sold out Amazon too early, or sold out Tesla too early, or Microsoft, any of these that have done thousands and thousands of % growth throughout the decades, 2 decades, selling too soon is also a problem. So, but what I want to ask you is, in terms of your risk management rules, you mentioned that you've always got a target price in mind where you'll at least sell some.
Yeah.
But I mean, if a position becomes, maybe starts as a 2% or a 3% weighting in your portfolio, but if it's shot the lights out and that is suddenly, it's been a 10 bagger, that stock is now possibly 20 or 30% of the portfolio. It's a disproportionately large part of the portfolio.
Sure.
Okay. Do you have some sort of a process where you would trim that back to try and kind of keep the weightings more aligned? Or do you say, no, this is the one, we don't sell a winner, we let it run and capture the maximum amount of growth out of that stock? Because I mean, as an investor and as a trader, I find this, and I'm sure you do too, is that knowing when to sell is the hardest part of trading or investing.
Oh, yeah. Well, JP Morgan was famously asked, how, sir, did you become so wealthy? Because I sold too soon. So, yeah, it's hard to know when to sell. It really is. But, I think this approach of mine works very well. It works for me to identify a target. And if the stock gets to that target, to sell half.
Yeah.
And, so if the position was 2% initially and the target, calls for the thing to potentially go up threefold, a 2% position then becomes a 6% position. Fine. Yeah. So you sell half, you still have a 3% position.
Yes. Yeah.
So you still have skin in the game. Actually, that's a reasonable position, 3%.
Yeah.
It's more than you had initially, and set another target. And if you think it doubles, then that 3 becomes 6. Sell half again. You still have a 3%, right?
Yeah.
So, that works for me. It's very tempting to just let a winner ride and ride and ride. But as you point out, you don't want to see something become 20% of your portfolio. That's just too much.
Yeah. I guess Warren Buffett might disagree. I mean, if he's look at the way he's done things, he just rides it. Okay, he does sell sometimes, but he's ridden some of those winners for decades, and it's done phenomenally well. But it's his way, I guess, of doing things. It's all very interesting. There's never one only way to skin a cat, and there's not only one way to invest. I guess it's interesting to have the discussions nonetheless. In what you're doing, and do you employ any technical analysis at all, looking at charts to determine your targets, or to determine perhaps a trailing stop loss or anything like that? Or are you all a fundamentals only guy?
Well, I would say I'm 95% fundamentals and maybe 5% technicals. I think any reasonable, balanced, thoughtful investor should look at the charts because they tell a story. I would never buy or sell a stock purely because of a chart.
Yeah.
Because remember, a chart is backward looking. It's telling you what already happened.
Yeah.
It doesn't tell you what you think is going to happen. That's where analysis comes in. Here's what I think is going to happen. Here's what I think could happen. Right.
Yeah.
But yeah, I think you have to look at the chart. That's just, like looking at the earnings history. What did they make last year, the year before? Is there a consistent growth rate? It's just another one of the factors that you employ in making a decision.
Right. Excellent. All right, Adam, I mentioned to you that I wanted to chat to you about the newsletter and to give it a bit of a punt, actually. I get the free version every weekend. I really should pay for the full version because what you do does look extremely interesting. Of a lot of things that I do get in the email box each week, yours is one that always piques my interest. And I find this American Ingenuity portfolio theme very, very interesting. I think also as a younger investor with hopefully a lot of time still on my side, this is the sort of thing that should be appealing to myself or people of my sort of generation wanting to invest. So just tell us a little bit about the newsletter quickly. That's the first thing. And then after that, I want to ask you about the money management side of the business, which you alluded to as well.
Oh, super. Well, thanks for the opportunity to tell you more about Bullseye. I mean, I love it. I have a lot of fun. I probably work too hard, but then again, most of us do.
If you love what you do, then I guess you're not really working, right? You're doing what you love.
That's a good way to look at it. So the heart and soul of Bullseye Brief is stock picking and coming up with a new idea. I say a new idea every week. It's not that I'm literally writing a brand new idea every week, because some weeks I might want to highlight a pick that's already in the portfolio and say, there's been some really important news and you need to pay attention, or it went back down and I'm adding more, right? So I'll call that a focus pick as opposed to a new pick. But that is the heart and soul of the newsletter every week. Each write-up on a stock is, call it 1,1600 words. So it's chunky. But it's digestible. I love creating graphics and telling a story with pictures. So what I typically do is I build all the graphics myself, and then I write around the graphics, because I think the graphics speak for themselves, and I'm a very visual person. So I want you to be able to look at the graphics and understand it. In fact, I highlight the first sentence of every paragraph in orange. The thing is orange and black. I just happen to like orange and black. I went to Princeton, where the Princeton Tigers, that's orange and black. Bloomberg is in orange and black. Old habits die hard. So Bullseye is in orange and black. But you could literally read just the first sentence that's in orange of every paragraph and look at the pictures, and you would know exactly what the thesis is. I try to make it easy for people. I think one of the things I do well is actually make complicated stuff simple. And I get a lot of pleasure out of actually doing that. Or creating order out of chaos is another way to think about it. And so that's the heart and soul, stock picking. In addition, the other half of the newsletter that I publish every week is our week ahead. What is some of the news on our various names, our 40 or so names in position? What are the potential catalysts coming up? What are the trades that I'm making, the buys and the sells? I don't trade very often, but I always put buys and sells. These are in the buy zone. These are approaching the sell targets, just to let people know. And then I also do what's called the Bullseye View. I think it's important to have some macro context. So I write one paragraph each on stocks, bonds, oil, gold, and the dollar. Again, that's the Bullseye View. And then I also do one editorial, just one paragraph that's kind of spicy and fun, and one chart, and I speak to that chart. It's my opportunity to just kind of loosen it up a little bit. So there are a lot of different components to Bullseye, and admittedly, that evolved over time. If I look back at the first Bullseye that I wrote back in 2016, to be perfectly honest, I think it's actually terrible. I'm my own harshest critic, but that's the way things start. It was very simple, and then I just kept kind of expanding it and rounding it out and perfecting the craft. And I'm now at a point where I will put Bullseye Brief up against any newsletter out there. I think it's really good. Of course I do. I'm biased, but I'm my own harshest critic as well. And I'm really very proud of the output. And I've got subscribers all over the world. And as you mentioned, that has enabled a money management business to grow out of it, because if you're a subscriber and you're reading the picks every week, and you enjoy that, you might enjoy running your own portfolio. There are also some people who say, gosh, this is a lot of work. What if I just give Adam the money and let him run it? And so that's how very organically, that's how the money management business sort of grew out of Bullseye. And so I guess you could say I really run two businesses, right?
Yes.
I write the newsletter, and I actually manage money in separate accounts for people. It's not a hedge fund or any of that. It's a separate account. Each person has a separate account on the Charles Schwab platform, and I simply have the authority to make buys and sells in that account.
Okay, so that's very interesting. Okay, I like the simplicity of that, actually. So it's not a fund. It's not, your money is tied up in some obscure structure. It's your account at Charles Schwab. You've given Adam the power of attorney or a mandate to trade on the account. And you as the investor can take your money out whenever you want or add more money in if you want, etc. I like that. It's simple.
It's clean.
It's clean.
Yeah, it's called managed accounts. And that's something that kind of grew out of the late 90s, early 2000s. And I think it's a wonderful way to run a business because it's totally transparent, and you can rely on the infrastructure of a big trusted firm like Charles Schwab. They do all the tax stuff and everything. And again, it's your money in your account. And so it's secure, and they're just that's the way to do it. Keep it simple.
Yeah, absolutely. I like it. I do like it. I like the fact that it's not cloaked in funny structures and tax havens and trusts and things. And some of these hedge funds are hell of a complicated, and you kind of wonder, like, how many hoops does the money have to jump through to get there, and ultimately how many hoops back does it have to jump through? So I like the simplicity of that.
Yes.
As we draw towards the end of our time, Adam, just tell us where viewers and listeners can see your work, where they can subscribe to the Bullseye Brief newsletter. And also, if they're interested in your managed portfolios, where can they get in touch with you to talk to you about that? Give it to us all. Tell us where, how do we follow Adam Johnson?
Well, thank you for asking the question. Bullseyebrief.com.
Okay.
Bullseyebrief.com. Self-explanatory. That's the website. And there's a video there, a 2-minute video that just kind of lets you get to know who I am, how I go about doing what I do. There's a sample of the newsletter, so you can actually see what potentially you would be reading every week. And then there's a 45-day trial for $45. So I think that's a pretty low risk way of getting to know me. I put my phone number and my email on every note that I send out, and I try to make myself accessible to people. So in the same way you and I are having a conversation right now, I have a lot of conversations like this with subscribers. I enjoy that, and I think that kind of openness and transparency is good for everybody. And I'll tell you also, some of my subscribers have given me some wonderful ideas that became Bullseye picks after I did research. So what goes around comes around. And certainly people listening now, if they want to reach me, can do so. AJ@bullseyebrief.com. That's my email, AJ@bullseyebrief.com. Or as I say, just go to bullseyebrief.com, find out a little bit more, and feel free to sign up for the trial if you like. And give me an email.
Brilliant. All right, Adam Johnson, it's been an absolute pleasure and a privilege speaking to you. I've really enjoyed this conversation. We are out of time, unfortunately, but I could carry on chatting to you for ages, but we're done in terms of our allotted time here. So thank you for joining me. I really do appreciate it. It's been a privilege and a pleasure. Thanks.
Oh, thank you, Garth.
Thank you. Thanks for joining us for today's episode of Talking with Traders, brought to you by IG, a world-leading CFD provider. We really are privileged to have such a leader in the field of online trading involved in this series. Please follow us on Facebook and engage with us there. And a reminder to make sure you subscribe to this series by clicking on the subscribe button on your favorite podcast app. If you've enjoyed this podcast, we'd also appreciate if you'd leave a review on the app too. Till next time.